Thank you everyone for joining us today for our panel discussion called ESG Trends and Implications for Accessing Capital in the Agri-Food Sector. My name is Brent Winnicus, and I'm the Director of Member Relations with Protein Industries Canada. I come to you today from beautiful Lester Beach on Treaty 1 territory in Manitoba. The member companies that Protein Industries Canada serves in Manitoba are located on the original lands of the Anishinaabe, Cree, Oji Cree, Dakota, and Dene peoples, and on the homeland of the Métis Nation. May we respect the treaties that were made on these territories and acknowledge the harms, mistakes of the past. For those of you who are new to Protein Industries Canada, we're an industry-led, not-for-profit organization created to position Canada as a global source of high-quality plant, food, feed, and ingredients. We're one of Canada's 5 innovation superclusters, and we partner with trailblazing companies and other ecosystem contributors to create and support projects that have the potential to transform the sector. We also work collaboratively with other sector supporters to capture Canada's global plant protein opportunity. Now, I was originally planning on just providing a quick introduction for the panel on behalf of Protein Industries Canada, but as some of you may have noticed, our good friend David McGuinness could not be with us today. And so yesterday afternoon, I volunteered to do my very best to fill David's very big shoes as moderator today. The idea for this webinar was actually inspired in part by the work that David is leading in the development of Canada's National Index on Agri-Food Performance. Along with our lead partners, Pulse Canada and the Institute for Food Security at the University of Saskatchewan, representatives from over 75 organizations have come together to develop Canada's first Agri-Food Sustainability Index. As part of this project, I sit on a working group focused on meeting capital market needs for ESG reporting, and I thought that our members absolutely needed to hear from experts on this evolving topic, especially those members seeking to raise or invest risk capital. And I should note that access to capital was rated as a clear top sectoral priority for PIC members in our most recent member survey, and it is a top priority on the road to 25 billion, which is a roadmap developed by PIC in consultation with our stakeholders. Finally, in my discussions with PIC's trailblazing companies, it's clear that the vast majority have sustainability front and center in their enterprises they are building and the products they are offering. That said, it was definitely less clear how their sustainability performance could translate into opportunity for access to capital. Folks are still joining. I see you're up to 28 now. I can tell you it was great to see that almost 100 people registered for the panel. So it does seem that we have hit a strong note with this topic. We have several startups and scale-ups in the agri-food sector, as well as institutional and corporate investors, and a number of not-for-profit government supporters, of course. And most folks are from Canada, but we also have a few joining from the US and the UK. So welcome, everyone. With that, it is time to hear less from me and more from our esteemed panelists. By the way, this is being recorded, so we'll be hosting it and many more people can take a look, and I'm sure they will. Before I get going, it's one bit of housekeeping. Please do ask questions throughout the discussion using the Q&A function at the bottom of your screen. And please include your comments in the chat box. I have an excellent team here supporting me, and they'll make sure that I do see your questions and get them addressed by our panelists. So let's jump into it, and learn a bit about our panelists. So my first question will be for Catherine Marshall. Catherine is the principal of Real Alts. Real Alts is a real assets consultancy focused on integrating ESG to improve long-term returns performance. Catherine is a leading voice on ESG and real assets in Canada and beyond, and she is a lead consultant for our ESG working group on the Agri-Food Performance Index. So along with the question I'm about to ask, I'll have each panelist just let me know where they're calling in from today and what brings them there if it's not their home. And so along with that, Catherine, perhaps you could start us off by sharing a bit of your background in regards to ESG investing and what you've learned regarding ESG in the agri-food sector.
Sure. Thank you so much, Brent, for having me here. And hello to all my other panelists. It's great to be here. So I'm dialing in today from cloudy Vancouver. And I purposely picked this food background because I just thought that it would set the tone. So I know it's a little loud. Hopefully it won't distract you too much from what I have to say, but oranges, lemons, and apples, pears, all nice, great fruits to contemplate as we talk about agri-food and capital markets. So my background is as an institutional investment expert. And for many years, I worked for large institutions such as the BC Investment Management Corporation and CPPIB, as well as institutional investment managers, helping investors to allocate to real assets. And certainly in the last few years, farmland in particular has come onto the scene as a very strong and very attractive investment. So that has set me down the path to learn more and more about agri-foods in general, farmland in particular. So one of the things that I've learned is that ESG is really driven a lot in the institutional world by the premise that there are a lot of risks that need to be managed, particularly in terms of lenders. They are very concerned about not only the value of their security in the midst of a growing climate crisis in which agriculture is really in the crosshairs, but also they're interested in looking for secure sources of income. And the food industry has always been seen as a safe and secure part of the economy because it's one of those consumer necessities, and really consumer staples is what agri-foods is called on the TSC index. So, certainly I think that the fact that the food crisis or that the climate crisis means that, food security is really coming to the fore, and, many of the groups that are approaching institutional investors are highlighting the fact that they represent a source of food security, really has been what's grabbed institutional attention. But I'd have to say that I think the major thing that everybody can be thinking about is not the risks, it's the opportunities. I think agri-food can represent a tremendous opportunity in terms of ESG. Obviously, everybody is interested in health and safety, and that's a major premise and a major opportunity in this sector. But also solving the climate crisis can be something that farmland in particular can address. So really, what I've learned is that, great, fantastic long-term source of secure lending, interesting new burgeoning opportunity for private equity, and really the big opportunity, I think, is to have everybody thinking about food and food security as a risk that can be managed and met well in Canada. And then Canada can also represent a great investment opportunity. And I'm hoping that actually my colleague Andrea will talk a little bit more about those opportunities later in this conversation.
Fantastic introduction. Thank you, Catherine. And indeed, we'll come back to, you gave a great high-level overview there, and we'll come back to some of those topics that dive in a little bit more in detail. And indeed, next, I'd like to introduce Andrea Gruza, Managing Partner with Bonafield Financial. She also has responsibility for Bonafield's ESG activities. So Andrea, I was looking at your website last night, and it dubs Bonafield as Canada's foremost provider of land lease financing for farmers. And so along with where you are and what brought you there, maybe you could explain a bit about what land lease financing for farmers is and how ESG plays its role.
Absolutely. Thanks so much. And thanks for joining, everybody. It's a pleasure to speak to you today. My hotel room isn't as nicely decorated as Kath's. I'm sitting on the other side of the continent in New York. And I'm here actually because I'm speaking at a panel at the Global Ag Investing Conference. And my panel is on sustainability in practice. And I only flag that to highlight the importance of sustainability and ESG for capital markets participants who are looking for agriculture investments, whether they are looking at private equity, ag infrastructure, or a sale leaseback. The topic of the week at this conference really is sustainability and ESG. So, really timely for this discussion as well. As Brent mentioned, Bonafield Financial is a farmland investment manager in Canada. We have been investing for a little over 11 years. And our model is based around the ability to provide agriculture operators, farm operators, some flexibility in being able to free up some of the capital that's tied into their land and use it for that next best opportunity. It could be to clean up the balance sheet, but more often it's to invest in some other parts of the operations, maybe to, we can work with them to secure additional acreage in order to improve their efficiency and productivity. But they, for whatever reason, don't want to be putting all of that land on their balance sheet. So we do that in the form of a sale leaseback, long-term rolling leases with our farm partners. And the equity for that comes from investors, high net worth, family office, institutional. So those investors are all looking for exposure to the attractive attributes of farmland and Canadian farmland in particular. So we have that through, fund structures. We're also launching in the next month or two a fund that works with farm operators beyond the farm gate. So, while we're assisting with their land financing, there's also opportunities to assist in things related to what we call ag infrastructure. So think storage, think processing facilities, what have you. And so that's where Bonafield plays. And where I sit, leading our capital markets practice and focused on ESG and sustainability, I have a lot of conversations with our existing investor base, as well as potential new investors, those looking to, provide us with capital to support our mission of maintaining farmland for farming. And they're asking me questions around ESG and sustainability, and they have certain requirements within their organizations to achieve sustainability targets, to report on what's happening within their investments from an ESG lens. And so I think, it's very varied between the investors. So I look forward to getting into some more detail on that. But I think, it ties in not only to the sale leaseback, but really any time an investor is putting money against an investment wherever it sits on the ag spectrum.
Awesome. Yeah, that's very interesting, Andrea. And I think that the idea of opening up opportunities for farmers to get into storage and processing especially is very interesting, and I'd like to explore that a little further in the conversation today. So thank you very much. Up next, I would like to introduce James Burrow, who is the Director of Sustainable Finance at BMO Capital Markets, where he identifies and addresses opportunities to grow sustainable finance products across BMO Financial Group as a whole. So James, it looks like you're in an office there, but maybe you could tell us where you're calling in from and what you're doing there, and also start off by explaining from explaining a bit about sustainable finance products, and also share how you work with companies in relation to ESG and what's important about this work.
Yeah, thanks very much, Brent, and hi to everybody, my fellow panelists and everybody in the audience there. Yeah, so calling in from Bay Street in Toronto here, we're just starting to move back into our offices on a hybrid basis here, so kind of in a slightly temporary arrangement. So my background isn't quite as nice as my fellow panelists, so you'll have to excuse me for that. But yeah, sustainable finance. I mean, I think when you think about what the offering is there, in the broadest sense, I'd draw two kind of main categories. One is sustainable use of proceeds finance, and one is sustainability linked finance. A bunch of stuff can sit under each of those two macro categories, loans, bonds, principal protected notes, various other kind of highly structured forms of finance, but it doesn't almost matter what the facility that sits underneath it is. I would draw the two distinctions of sustainable use of proceeds and sustainability linked. And what those mean are, well, sustainable use of proceeds is effectively what people might know as a green loan or a green bond. And what it is packaging the loan or a bond according to how it's been used. So for example, on a farm, you may issue a green use of proceeds bond if a farmer wants to work with a major utility on setting up a solar or wind power kind of generation capacity on their farm. The key element there being that the actual use of the finance, the use of the proceeds, is going into something that is entirely sustainable. The other category, which is probably the one that's known better, is sustainability linked financing, which is where the use of proceeds can be relatively neutral. It can be just for kind of operating cash flow or whatever. It doesn't necessarily matter what the money is being used for, but it is linked to an improvement in the sustainability performance on behalf of the borrower or the issuer. So, for example, and the other thing I would say is it involves a pricing adjustment. So, for example, on a $200 million facility, you may get, X basis points pricing adjustment if you manage to reduce your greenhouse gases by 2030, by 30% by 2030. So effectively, you're getting rewarded for improving your own sustainability practices. The rewards aren't necessarily enormous, but they are material, and they add another kind of layer of the value proposition, in addition to being able to kind of market your financing as green and sustainable. The final thing I'd say about it is a very efficient, a very attractive way of bringing in new investment that you wouldn't necessarily be able to tap otherwise, because the markets for ESG investments, the capital markets for ESG investments are growing, significantly. There are large corporate, institutional, and retail investors who want to invest in an ESG aligned way. So being able to issue green bonds or sustainability linked loans enables you to kind of tap sources of capital that you wouldn't necessarily be able to do otherwise. So I think, I won't go on anymore, but that's how I would draw the distinction, using those two categories of sustainable finance.
Fantastic. Yes, thank you, James. I think, it's a great place that we find ourselves in, where you can get rewarded for being sustainable. So I think, this is a pretty interesting and beneficial trend to society, and affecting the social as well. So thank you for that introduction. And before I just introduce the last panelist here, just remind everyone, if you have any questions, just throw them in the chat. We'll address them as we go, and you can really help direct this conversation, because this is for you. So next, last but certainly not least, I'm pleased to introduce Ryan Bracken, co-CEO of Merit Functional Foods. Ryan has over 18 years of experience in food manufacturing, including as VP Innovation with Manitoba Harvest. He also has led financing, development, and commissioning of Hemp Oil Canada's 40,000 square foot facility. So along with where you're calling from today, Ryan, I know there are a number of members online who could benefit from hearing about your story. So I'd like to give you a bit of real estate here for your opening response. So let us know where you are, where you're at now with Merit Functional Foods, and a little bit of background about how you got there and how ESG played its role.
Absolutely. Appreciate the opportunity to be here, Brent. So I'm based here in Winnipeg. We built a brand new dedicated 100,000 square foot facility, northwest corner of Winnipeg. Actually, it's in the arm of Rosser. We've been in operation here now for roughly a year and a half. Prior to that was a year of construction, and so we're very much a startup by all definitions of a startup business. We formed this business in July of 2019 with the belief that there was a need for better quality, more sustainable, more functional plant-based sources of protein manufactured here in North America. I came myself, my past business that I was part owner of and manager of was a company called Manitoba Harvest and Hemp Oil Canada, which is the world's largest hemp food company, albeit still a small business. but with strong roots here in Manitoba. Prior to that, my career was with some consulting work, and part of that was in the animal protein business with Maple Leaf Foods. So a long history in the food business, but I would say in my last 10 years has been focused on plant-based proteins, and really see that as the future. I think plant-based foods are growing exponentially. You can look at any of the data and metrics out there right now. There's a strong presence, and obviously the reason for Protein Industry Canada is for being is to drive all things plant-based protein. Plant-based foods really have a challenge. Their biggest challenge right now is what we obviously are driving towards, which is higher functionality, higher taste, and better sensory performance. Consumers right now are looking for products that they can replace their normal meat-based diets with a more flexitarian lifestyle. They'd like to go more meatless and have more meatless Mondays, and simply just want to eat healthier. They want a more active lifestyle, and that means less meat, less dairy on their plate. They care about where their foods and beverages are coming from. They want to know that where their product is made and how it's made. So they care about things like animal rights and animal husbandry. There's obviously a big push towards those different pathways. But what that's typically leading to right now is just a predominance and growth of plant-based foods and beverages. So that's really where Merit Functional Foods plays. We have our offering currently consists of both pea proteins and canola proteins. We sell our proteins as ingredients. So we sell them as protein powder, 20 kgs in a bag. It goes 40 bags in a pallet, and you sell an 800 kilogram pallet, right? So that's what we sell. Our customers are large consumer packaged goods companies. I would say large to medium to small, all over the place, both domestic and international. That's our focus. Our goal is to assist large consumer packaged goods companies with formulation of new and or reformulation of existing products. So we help them make things like plant-based ice creams. We help them with plant-based meat alternatives. We help them with plant-based dairy alternatives, things like plant-based cream cheeses, plant-based cheese, plant-based dairy alternatives, and those types of things. Ready to drink beverages, ready to mix powders. All of those categories are things that we play in and we assist large consumer packaged goods companies with. So that's just to give you some perspective on what Merit Functional Foods is all about. Our operation here, like I said, has been ongoing now for about a year and a half. We're producing commercial product here. We run 24/7, and we have about 120 employees. So we're by all stretches of the definition of startup. How does ESG play into Merit Functional Foods? Obviously, our story is a strong clean tech story. When we came to bring this business to fruition, we obviously had to go look for financing, like everyone. And I think that's to your point, Brent. I think a lot of the feedback in PIC right now is exactly that. Where do I get financing? How do I start my operation? How do I grow my operation? We were there. It's not easy. That is probably the biggest challenge for any startup. First and foremost, I'm not trying to push back on James and whatnot, but the reality is when you're talking to the big six in Canada, they typically are not interested in startups. It's just not in their wheelhouse. It's not of interest to them. They're happy to talk to you once you're cash flow positive and turning equipment, right? So from our perspective, we had a long history in the food industry. We had a long, strong partnership with Farm Credit Canada. So Farm Credit Canada is a debt partner of ours, and likewise is a Crown Corporation here in Canada, and the other debt financer for us is EDC, so Economic Development Canada. Really, where we kind of had to go through the window of ESG was obviously in the early stages of financing and validation of our environmental social action plans. As a startup, typically you don't have all of these things, so you have to develop these things, right? So we went through a process. We obviously worked with some outside consultants, but we also had a strong background from our history as far as running other organizations. Our manufacturing leadership had a strong background in the food industry and have developed environmental social action plans. So if you're going through this process, it's something that you definitely have to think about, and making sure that you understand not only your operational environmental social action plan, but also your construction plans, right? So if you're, in our case, we're constructing greenfield projects, we're putting on brand new dedicated land, and you have to think about what does that mean as far as your environmental plan. How are you going to mitigate any risks associated with your environmental footprint, right? So that was the general theme. Behind the scenes, I've always been a proponent of ESG principles. Our last business that I managed was Manitoba Harvest. Manitoba Harvest was the first food company in North America to be carbon neutral. And, Maple Leaf Foods has definitely marketed that. They marketed it, I believe it is the first large scale commercial food company to be carbon neutral. We were carbon neutral at Manitoba Harvest 5 years prior to that. So strong believer myself in looking at your footprint and understanding how that's impacting the rest of the world. The easiest thing from my perspective, easiest way out is to look at carbon credits, and obviously that's where most go to deal with their carbon footprints. I take a little bit different approach. We built this facility, we designed this facility. I'm an engineer. We designed everything. We designed sustainability into the footprint of this organization. So our biggest footprint obviously comes from natural gas usage. We're drying powders with spray dryers, and those spray dryers use natural gas to heat airflow and to dry a product from a liquid state to a powdered state. And so, and beyond that, obviously, we have other parts of our process. We're heating products and cooling products, you name it. So you're using chilled water, you're using heat and whatnot. So we built in sustainability right in the footprint of our facility. And how did we do that? We looked at all sorts of things like retaining that heat by looking at regenerating heat in our process. We're using the spent heat from one product to heat the next product, the incoming product, and things like that, right? So those are all things that we obviously played into it. From electricity perspective, using things like variable frequency drives, all those things and types of things, we definitely played into it. And then beyond that, obviously, just making sure that you're open and willing to look at all sorts of pathways to look at sustainability. And we drove all those things into our planning phases through the engineering phase. So happy to get into more details. I think obviously I get into the weeds very easily here, Brent. So maybe I'll just step back here and see if there's any further questions from there. But that's probably.
Oh, that was fantastic, Ryan. Fully anticipated getting into a bit of detail there, and I think for a lot of our members, they'll be very interested in that and your story. And I know you have a lot to offer from your experiences in getting to where you are now with Merit and $150 million facility, right? And operational within a year and a half during the pandemic. So pretty interesting story there. And then also, I mean, you did, mention James and the challenge. It's a well-known challenge. It's not James or any particular institution. It is a challenge for startups to get that level of financing. I don't know, James, let's start to open it up to you to see if you have any comments on that.
Yeah, I mean, I guess it's a problem beyond that extends beyond the kind of sustainable investing and investing into sustainable companies space. Banks' risk appetite, particularly in Canada, does not necessarily enable them to go deep down into the kind of startup space. We do have a few areas. We have an impact investing fund. We have a capital partners fund. We do have parts of the bank. We've got up to $1 billion in balance sheet that does invest in kind of early stage startups, almost half of which invests in is an impact investing fund, which invests in kind of really early stage sustainable startups. But yeah, I would definitely acknowledge broadly the kind of systemic problem that Ryan flags, and you have kind of government lenders stepping in there like EDC and BDC, but yeah, it is a problem. So yeah.
No, and that's fair, and it's not just Agrifood. It's across the board, and it's not necessarily a problem. It just is what it is. I guess it's risk mitigation, and that's partly what ESG is about. Andrea, Catherine, any comments on that or anything else?
I think just to pick up on something James mentioned, I'm not sure we've stepped back and really discussed what ESG might even mean to an investor. James, you mentioned impact. One of the things that I've found, I'm having discussions daily with investors, primarily in Canada, but many around the world, and no single investor is alike. Now I'm dealing more with private investors, large pension funds, endowments, foundations, family offices, not, as James is sitting on kind of the bank lending side. But I can tell you that everybody talks about ESG and everybody talks about sustainability. Some of them have very well defined examples and definitions of what that means to their organizations. Others, many do not. But even those who have really well-defined ideas of ESG for them, it's not the same investor to investor. And so, that makes it challenging for folks looking to raise capital. But I'd say it also provides an opportunity, because likely, no matter what your current structure is, you will find that investor to meet your needs. So we're in the early days, believe it or not, of ESG and sustainability, to a point where it still is not widely prescriptive. I think a lot of farm operators we speak with, they hear about sustainability and they think, well, what are you doing? Are you going to make me become a regenerative agriculture expert? Are you turning me organic? Bonafield is not telling our farmers at all how to operate, so that's one thing, but no. Maybe some impact investors specifically are looking to invest in a transition of some type, but what that transition is going to be different. I mean, organic isn't always better. Regenerative may not be better if you're looking for immediate financial returns. But so it's still very, very undefined. But what I think we can all agree on this panel is that it's there. And so, whatever steps, your members can be taking to understand where they fall with respect to sustainability and ESG, and whatever they can implement that works within their model, it's going to become increasingly important. So, that's not to say everybody become green, but the industry is moving to a point where they, at the very least, want to benchmark to understand what the operators are doing.
Fantastic, Andrea. Yeah, a lot of insights there. I think we want to unravel a little bit more. But I'll first go to Catherine and give you a chance to comment here.
Thanks very much. I wanted to say that one of the things that could be highly important to many of the people on the webinar today is private equity financing. And I just wanted to delve into that a little bit, because I think that many people find private equity financing a bit of a mystery in the first place, and then don't have an understanding of how ESG could play into that. So private equity has always sought very high initial returns. And that has been one of the things that has precluded the food industry from a lot of private equity, because unlike tech companies that can anticipate, a 200% perhaps in investment return to investors, food companies have never been able to offer that kind of return. What I think is changing is that, especially the large institutional investors that I know and work with, they're very frustrated with private equity, because those funds have typically been doing the least amount of reporting and least amount of financial supporting of ESG. And so I think that one thing that many people could consider is that if they have a very, very strong ESG story, and because they're a startup, they have, the potential of good returns and also far more stable and predictable returns than a tech company, that they may have a much better chance of getting a piece of a private equity fund on that basis. So I would say that, one of the things that people should think about is, if they want to go to a private equity fund, as I said, one of the shortfalls of private equity has been poor reporting of their ESG story, and particularly quantification of the ESG story. If you can go to private equity where, like Ryan, you've been thinking right from the very beginning about what your ESG story is going to be, and you've been setting it up so that you actually can measure it and talk about being carbon neutral, that may in fact open doors for you in the next couple of years that up until now have been pretty close to food startups. But I'm just going to throw this out to everybody else on the panel. Any comments on the role of private equity and the ability to bring private equity a growth story with a quantified ESG aspect to it?
Kath, I think that's right. I'd agree with what you're saying. I mean, the people on this call don't need to be convinced of the macro drivers and the strength and long-term performance of agribusiness and agri-food, and particularly how unique Canada is positioned with respect to that climate change story and potentially additional optionality and value enhancements as we see, our access to fresh water remain, knock on wood, assuming we're managing it appropriately, as well as the changing growing conditions that may support the types of crops that we're able to grow in Canada. And I think the private equity investors are catching on to agriculture isn't simple. It isn't boring. It's stable over the long term, but there's a lot of innovation. You look at what Ryan is doing and alternative proteins, right? The purpose of this group. That really gets them excited. And many of them are looking at ag tech. And those investors then are looking at their overall portfolio and they're saying, okay, we have connections with this ag tech company. We then may look to create maybe some non-tech related investments in agriculture, and maybe 1 + 1 = 3. And so maybe they can be supportive as well to the businesses that they're investing in and being able to bring them enhanced operating capacity or support. So I think you're right that they're looking at the whole portfolio now rather than just that one-off, 200% return winner.
Yeah, maybe I'll just step in because I have some history with private equity. Our last business was purchased, Manitoba Harvest in Hempel, Canada, was purchased by private equity, actually publicly traded private equity, which is its own beast and unique in itself, a NASDAQ traded company. So been there, done that, had ownership. I was minority investor after that purchase, and yeah, I think it definitely plays well. I think private equity can actually play really well into a growth story. Ultimately, in this case, private equity was driven obviously looking for earnings. And this company's drive was to push out dividends and whatnot. So in our case, we had to be driven that way. So maybe not necessarily a good focus for a startup like mine right now, of course. But I think just in broadly speaking, I think everyone has a piece in the growth of this space. If I was doing everything all over again and starting up again, I think I would look at definitely reaching out to brokers and who have access to the landscape of all private equity companies out there, because I think there are multiple private equity companies out there that have different mandates and have different needs. And may see value. And I think in my story, for example, here, really the need is for patience, right? For patient investors to recognize that when you're growing something as a startup, it doesn't go from 0 to 100 and from 0 to 100% profitability in the case of a year or two, right? It's a growth story, of course, right? So if you're in it for the long haul and you believe in the story and you believe in the space, and you believe there's a future pathway there, then yeah, that's where you're looking for those patient investors. There are definitely private equity companies out there that aren't necessarily as patient, but I'm certain that there are others that are. And I agree 100% to your point, Andrea, as far as there may be a good fit with certain parties out there. I think the biggest challenge, just speaking for myself, as an entrepreneur, is really just finding it's finding that pathway. It's finding those partners. And when you're in the trenches and you're starting up a business and you're trying to manage, procuring this and starting up this and growing this, staffing here and staffing there, and then all at the same time trying to raise raise funds and whatnot to grow your business, it's not easy, right? So I think that's probably, Brent, partly why I can imagine why participants with PIC really want to hear about access to capital, right? It's like, how do you access capital? And ESG is a great story, and I think we have a great story in the PIC environment. Anyone that's a part of it has a great story. It still comes down to is who do I tell a story to, and how do I find those partners?
And Ryan, making sure those partners are right for you, right? Not all private equity, not all institutional investors are the right fit for every company or every opportunity. And you need to be prepared to properly diligence and make sure that they might be the right fit for, you know, your competitor or one of your peers, but for whatever reason, it's not right for you. So I don't want any of us to be seen to be suggesting that all money would be great. It also needs to be the right fit.
I think that's where in my mind a broker, you know, my history tells me a broker can really help the cause, because they can be the in between to help you as a entrepreneur. I'm just speaking obviously from my lens. If I were doing all things all over again, they help you tell your story, but also find you the right partners and allow you to spend the time necessary in your business. To focus on your business, and they will, you know, take over that sourcing of that capital, right? And I think people need to think less of the cost structure associated with brokers and more of the value alongside it, because you need to find those partners, and it's not easy to find them, but they have those pathways to find those partners, right? So I think that's my messaging to any entrepreneur out there looking to do something like I have done multiple times. It's tie yourself in with a strong partner. Strong investment banker of some form, and there obviously are many different companies out there. It's interesting. In my case, they all came to me after the fact. After I had spent $150 million. It's finding them before you spend $150 million. That's the hard time, right? So from my experience, I now know who to reach out to. But if you're in my shoes 3 years ago or 5 years ago, it's not as easy, right? So it's you live and learn, and I think that's where hopefully the PIC environment can help out. And I'm happy to, if anyone's part of Protein Industry Canada and wants to reach out to me, I'm happy to share some of my lessons learned along the way.
Awesome. That's amazing advice, Ryan, and just a great perspective that you're bringing to our members and the audience here. There's a bit of a string of questions in the Q&A. It looks like someone will need to digest this a little bit. I don't know, maybe Catherine and Andrea, you can think about this question a bit while I'm going to go to James next. And just, James, did you have any comments on what Ryan was saying and Andrea about, partly about the trend. So what you're seeing in terms of trends, ESG is relatively new, but it's obviously rapidly emerging, and many investors know about it. I would say of the members I've talked to, about 50 to 60% knew the term ESG, so not everyone was on board with that, although almost all of them are focused, have a sustainability element to what they're doing, environmental sustainability. So maybe a comment on that.
Yeah, I mean, the perspective that I'm getting from the kind of capital market side of our business is more to, large corporate clients. But let me kind of paint a picture. In 2019, the top three kind of global CEO risks were fiscal crises, cyber attacks, and unemployment/underemployment. In 2022, the top three risks are climate action failure, extreme weather, and biodiversity loss. And actually, in 2022, 5 of the top 10 global CEO risks are all sustainability and climate related. So, that paints one picture. Another is that, in the last, I think, over the last 5 years, the Science-Based Targets Initiative, which helps large companies set meaningful, credible emissions reductions targets, has seen an over 50% CAGR in the number of companies signing up to it each year. So in the corporate space, certainly there's been an absolute kind of explosion in awareness and commitments to making meaningful reductions in emissions. Obviously, that only kind of takes care of the E part of ESG, but as I think you mentioned previously, Brent, a lot of focus is there. So yeah, so definitely in the corporate space, a lot of focus there, a lot of growth in focus. What we don't feel we have a great gauge on yet is the degree to which that's filtering down to SMEs. We know that's going to come. We don't necessarily know exactly quite how quickly SMEs are going to awaken to the opportunities and risks of the climate transition. But one kind of big thing to maybe think about for the agri-food sector is the role that buyers will play. So, for example, Walmart has something called Project Gigaton, which is a project to remove a gigaton of carbon emissions from its supply chain by 2030, which is a huge amount of carbon emissions and is ambitious for even an organization of Walmart size. But what that means is that for suppliers of Walmart, of which there are many, they will increasingly feel the pressure as Walmart exerts its buying power on its supply chain to reduce their emissions too. So what am I saying? I'm saying basically there's been a massive growth in focus at the corporate level on ESG targets and realistic ESG targets. And ultimately, whether it's within 6 months, whether it's within 2 years, we think that is going to start to filter down pretty rapidly into the SME space. And frankly, we are in the process of gearing our business to deal with that. As you can all imagine, banks don't move as quickly as private equity firms, and I kind of sit closer to the center, where we're doing a lot of thinking about this, but our relationship managers and the people that lend to farmers, actually out in the field, literally and metaphorically, are not necessarily thinking about it as much as we are. What we're trying to do at pace now is equip them to do that. So how do I lend to a farmer who wants to fit solar panels on their roof? How do we understand regenerative agricultural practices better so that we can lend to them, given the sort of slightly longer payback periods than are typically associated? So we are partnering with our clients, and we're sort of learning with our clients at the same time about how we grow and how we lend into these new spaces as they develop. But it is right up there on kind of at the top of the agenda for the bank.
Well, that's great to hear. And yeah, so it's great to hear it's heading in the right direction, and you see the winds of change kind of continuing towards support for SMEs, for companies like Ryan's who are scaled up but could scale up a lot more. So potential for that anyway. So fantastic. So I'm going to turn to Andrea, who I believe is going to respond to the questions that we received. And Andrea, if you could just distill your understanding of the question and then your response, that would be awesome. Thank you.
Sure, I'll do my best. And so there is a question posed here by one of the attendees in a few different parts. And so I'll do my best to address it. It's specifically related to how Indigenous businesses can avoid being diluted out of being Indigenous owned and controlled through investment. And I suppose it has the same parallel for, even just owners thinking about that, or maybe female-led or minority-led. But I certainly do appreciate the Indigenous context here. And we've been given, just some commentary and example about how various lenders may have wanted to be very prescriptive in saying, well, we'll lend, but change the ownership control or do different things. And so, questions around how do you avoid that, and how do you find the capital to fit with your specific situation without facing, maybe some of that institutionalized prejudice against your organizational structure. I don't claim to have specific experience in this, but my thoughts on this would be that, as I said before, there is different capital for different purposes. Private equity, maybe direct investment from the investor into the business, tends to want to always take more of a active ownership role, and will be potentially quite prescriptive, and maybe because they feel that they're taking more of a risk, and they want to benefit from that risk by being able to direct some of what's happening. So maybe in that context, that isn't the right form of capital. Maybe it's to work with a fund manager where their investors take a very passive role, and you're one of many pooled assets. And as a result, you're dealing with the manager, and the manager has a different type of approach. I mean, that's the way that Bonafield operates. When we think about our farmland leases, we're never telling our farmers what to plant that year. We're not telling them where to support to source their inputs. They're the experts. We have underwritten their business model and them as operators, and we trust them. And they should be the ones driving the business. So presumably you'd like to find somebody who looks at your current business and is aligned with your long-term strategy and lets you do that. Obviously, you're going to have to report to them. You're going to have to show that you're following your business plan. Those investors do exist. The other thing that I would think about here is we've talked about ESG. It considers three elements: environmental for the E, S is the social, and G is governance. And investors, when they think about ag, very much focus on the E because there's that natural relationship between the value of the underlying asset and environmental considerations and what you're doing on the land. But the S is a really big component. And I would say, not stories, but examples of how that investment is supporting society is something that drives a number of investors and increasing in importance. So I think you can find many investors who are looking to support businesses, Indigenous-led, maybe businesses that are supporting local communities, and they can do those investments on a large scale. It doesn't have to be really small dollars to do it. There's significant large investors who value that diversity, and they're looking to put their dollars against it because they know that there is value in diversity, and you don't just want one homogenous portfolio run by a bunch of people who all look the same and have the same ideology, because there's risk to that. That's overconcentration. So I think it's, to Ryan's point, it might be hard to find those folks because they're everywhere and you're sitting kind of where you are, but they're out there. So I'm sure to the extent that Brent and his team can support, that's a great resource to start with.
Fantastic response, Andrea. And I was thinking the same thing about getting into like the social aspect of ESG. Before I move on from this, again, a great response to kind of a difficult question, I think. Catherine or anybody else want to add on to that? No. Okay.
No, I will. I just thought I saw Ryan moving to demute his mic. Okay, so I want to talk at perhaps a very, very high level on this de-risking idea. And that is that, one of the ways that you can present less of a risk, and particularly, I think, if you're in a startup mode, so that you're making all kinds of investment decisions about your business right at this moment, is to be thinking about the fact that if you represent a organization that's presenting solutions to the environmental problem, the climate crisis in particular, and that you're thinking about the fact that your business needs to be resilient to the long term, to the fact that there is a huge energy transition coming. And you want to say, basically, my business is going to be energy transition ready from day one. I'm not going to be investing in a whole bunch of equipment and a whole bunch of technology that is going to be very redundant in 10 years. And I'm going to have to go and basically retool everything, which is highly expensive. So I'd say there's just a bunch of high points on the energy transition to think about. First of all, is be thinking right from the very beginning, how are you going to produce green energy? There are lots of ways of doing it. Ryan's talked about the fact that he's recycling energy. Electrify everything that you can right from the very beginning. The internal combustion engine is going to be a dodo in 10 years, I believe. Buildings that are energy efficient and resilient are putting you in a position where you are immediately going to your bottom line over the longer term because you're not spending money needlessly on expenses. And I think the holy grail is to be thinking about creating carbon credits. Clearly, producing green energy creates carbon credits, but the big opportunity is in the farmland area, because we have millions of acres of farmland that can be producing carbon credits. And Alberta showed that it was possible to do it. That program is ending, but there are now lots of private opportunities that will be emerging over the next 10 years to be producing carbon credits. Right now, one of the largest institutions in the world has committed to going to net zero. And every single investment that has to come into their portfolio in the next 10 years is going to be scrutinized for its ability to represent a contribution to their net zero or carbon neutral commitment.
Yeah, I maybe just to add to that. I think I'm very practical. So when it comes to what can we do from a sustainability perspective, I think, you know, what's a tangible thing that I can do. I would say that if anyone's out there that's just, you know, an SME like us, I think there's all sorts of pathways out there that you can improve your story. In our case, even though we're a startup, we're constantly looking at ways to improve our overall footprint. So some small examples would be like insulating our equipment to make sure that if we don't have heat loss. We were able to tap into government programs. In this case, Efficiency Manitoba offers programs to support energy efficiency improvements. So optimization of use of things like heat exchangers, like I said earlier, using things like variable frequency drives and motors, insulating anything that has to do with heat so you can minimize heat loss. All of those things, I think, play into your story, and I think it has to be told. I think, you know, a broader perspective from us is, you know, we're competing against the Chinese, we're competing against the Europeans, we're competing against everyone else in the world. What is lost, and it's unfortunate, we love to tell a story. We are North American made products. If you're formulating a plant-based food or beverage, you can buy our product. It has very, very minimal footprint from a carbon perspective. What's happening, our competition is buying Canadian whole peas, shipping them to China, processing those whole peas, shipping the protein right back to North America at a reduced price point. Obviously, they're able to benefit because they have a significant noodle market there where they're utilizing the pea starch, and they're able to offset the price point of their proteins with their starch sales, which we don't have a strong noodle market here in North America. But it's not a great sustainability story when you're shipping whole peas all the way across the ocean and shipping that protein all the way back here. We obviously love to tell a story. The challenge really comes down to, from a supply chain perspective, the big CPG companies, they're still looking at the bottom line, right? They're still looking at saying, hey, I can buy this protein here for half the price of Ryan's protein. And do I care about price, or do I care about sustainability? And that still is the struggle. That is the struggle, because there's no cost associated with that sustainability story on them to make that decision, right? So obviously there are some trade embargoes and tariffs being placed on China and things like that have some impact. But broadly speaking, I would tell you that there is still hidden inefficiencies if you're talking about ESG footprint, sustainability in the food, agri-food space right now. It still comes down to bottom line, right? People still want to spend as low as possible. In our case, obviously, our story is not just an ESG story. Our story is about functionality, taste, nutritionals, you name it. That we obviously are not playing off of just ESG, because if that's all we were playing off of, it would be a very big struggle, because price still comes into it, right? When you're producing product in North America, it's still going to be a higher cost than producing in China as it stands today. So yeah, those are things to watch out for. But I think it's still early days, as our panelists have said. I think I'm hopeful that the more and more consumers are aware of what they're buying, and asking questions where these products are coming from, not just where it's made. In most cases, you make a food product here in North America, but all the ingredients are coming from elsewhere, right? So I think the more and more transparency takes rise, I think it will. Consumers will want to know where these ingredients are coming from, and believe that will transition to made more local ingredients. In our case, obviously North American. So.
Fantastic, Ryan. And yeah, your response there leads very well into our next question from an anonymous attendee. And it's very topical. Might be a challenge to respond to, but I'm going to ask the panelists to get out their crystal ball if they're interested. And I'll start with James, and maybe you could distill that question down for us and let us know what you think.
Yes, I mean, to try and distill the question down, really what's being asked is how does the Russia-Ukraine conflict and the associated kind of energy supply, energy security issues that arise out of that affect how we think about investing in the ESG space and the energy transition? And I guess my answer would be, well, the conflict raises two major concerns that I think everybody can agree on. The first is a short-term energy supply issue, and the second is a long-term energy security issue. The energy supply issue, the questioner correctly points out, like in the very, very short term, that's frankly going to need to be dealt with by a step up in, in traditional fossil fuel based energy sources. Like, we're not going to be able to build enough solar and wind to deal with, the energy needs that arise out of this conflicts in the next, 3 to 6 months. What I would be hesitant about doing, and what I would actually guard against, is confusing that for a long-term trend towards fossil fuels, because actually I think the energy security imperative that comes out of the conflict will actually nudge things in the other direction, because what is a more secure and kind of sustainable and stable long-term source of energy than solar, wind, hydro, and other clean sources? So if you're thinking about how to address that long-term energy security need, and you could go down one route, which is build more coal and build more natural gas, or you could go down the other route, which is build more solar and hydro, like, which is more risky in the long term? And I would say the natural gas and the coal is far more risky in the long term, because of ramping up government policies that will effectively, due to carbon pricing and incentives on the other side, basically price those ways of producing electricity out of the game. If you're building a gas-fired power plant now or a coal-fired power plant now with a lifetime of 30 years, there's a huge risk that in 10 or 15 years, effectively, that's going to become a stranded asset, whereas that's just not going to happen with solar and wind power. So what I would say is to summarize, is the kind of imperative for greater energy security actually in the long term nudges the development of renewable sources of power more than it does of fossil fuel-based sources of power, I think. I mean, I'm sure people would take a more bearish view on it than that, but and I'd be interested to hear the responses, but that's certainly my view. And I think it's the view, honestly, of the energy transition group at the bank here as well.
Fantastic, James. Well, appreciate that response, putting yourself out there and your opinions. And I think, if we go too much further on this question, we might take up more than the rest of the time of the panel. But I will open up the panelists if there's anything they really want to say on it. Otherwise, we'll move to I guess, with 10 minutes left, maybe some final closing remarks from everyone. Okay, perfect. So I think maybe as just to end things off with maybe some practical advice for members that are looking to scale and incorporate, make sure their ESG story is getting told. Advice or one piece of advice or something to watch out for to avoid pitfalls. One piece from each person. I'll start with you, Catherine. Oh, you're muted.
I'd say the words are greenwashing, rainbow wishing, whatever you want to call it, is to avoid telling an unauthentic story. I know that investors at one point didn't really understand ESG, and I'm not saying that there isn't some confusion now, but clearly not only investors, but the regulators that are in the background are insisting that these stories be authentic. And authenticity really requires proof. It's like trust but verify. So I would say that people should be thinking right at the very beginning, if possible, about what their ESG story is, and to be setting up systems, processes, some technology to actually track it. Showing progress is one of the best ways to verify that, in fact, your story is true and that your intentions are real and that there are meaningful outcomes, because that's what investors are looking for. It's not stories, but outcomes.
Fantastic, Catherine. That's perfect. And then maybe Ryan, I'd be interested just, briefly, and it might be hard to answer briefly, about that measurement piece. What advice would you give there? What works? What to avoid?
Yeah, my experience, both in past businesses and the current business, I think is absolutely that. It's if you don't measure it, you obviously can't manage it, you can't improve it, right? So I think it's getting a baseline of your organization's footprint. Start with scope 1 and scope 2 greenhouse gases, which effectively is what's your electricity, what's your natural gas usage within your organization. Scope 3 obviously starts getting outside your organization as far as transportation logistics. Start with scope 1 and scope 2, identify what your overall usage is. There's partners out there that you can work with that can help you with tools for calculating your greenhouse gas usage and consumptions and whatnot. Understand what your footprint is, first of all. Second of all, understand what your biggest drivers of usage are. In our case, our storyline is a strong one. In Manitoba, we have, no different than BC and Quebec, we have a very, very environmentally friendly source of hydroelectricity, right? So from a greenhouse gas perspective, even though we're a big user as a manufacturing facility of hydroelectricity or electricity in general, it's a very, very low carbon footprint as far as electricity is concerned. Versus go across the border, and some of our competition is based in Minnesota and Wisconsin, where it's coal-fired power plants that are sourcing electricity. It's not a great story, and so there's those unique differences that you can pick up in your own industry, and that's a selling feature, right? That's a selling feature to your customers. That's a selling feature to investors. But beyond that, it's also then, okay, what are you going to do about it, right? What are you doing about that footprint? And what are your biggest forms of usage? So obviously in our case, natural gas is our biggest form of greenhouse gas from a scope 1, scope 2 perspective. And what are we doing about it? We're doing things like I said earlier, insulating equipment to make sure we minimize heat loss. We're using heat exchangers to minimize use of heating cold winter Manitoba air, things like that, right? So it's being practical about what you do and what you're seeing and measuring it and telling that story, right? So I think consumers care, investors care, but it's hard to tell a story if you don't measure it. So that'd be my advice for others.
Fantastic, Ryan. Yeah, great practical advice for anybody listening. So, James, your final thoughts.
Yes, I mean, I guess when we look as a bank to lend to different companies, we obviously look at the business model, we look at the risks to the business model, and we look at the opportunity that business model kind of presents over the long and medium term. So I would encourage people who are looking for lending, who are looking investment, to think about the risks and the opportunities that the kind of the race to net zero or the climate transition presents. So the risks for a business, I guess the biggest risk that is common across all industries is basically you want to start looking at ways to manage your emissions downwards now, so that you're kind of future ready for the future economy, to electrify, to make your business more kind of sustainable, so that you're mitigating any kind of climate either transition or physical risks to your business. And on the other side, we'd be looking as a bank to understand how you're positioning yourself against the opportunity. Whatever your industry you're in, it's likely that it will be in some way impacted by the climate transition. So we would want to understand how you are positioning your business for future growth against that market. So my encouragement, if I could sum it up, would be to look at both the risk and the opportunity side of the climate transition and make sure you're positioned well against both of those.
Excellent. Yeah, great advice for our members to start planning now for the future capacity to raise capital. So thank you very much, James. I know you have to leave right at 15. I think we'll be pretty close to stopping right then, but in case you need to leave, thank you very much for your participation today. It was excellent. Andrea,
thank you.
Final word, final thought goes to you.
I mean, I think, my advice to people on the call would be don't panic and don't feel bullied into doing something that doesn't work with your business. We're talking about a lot of different things, maybe making the suggestion that everybody just has to go rush out and do this. And I don't think that's the case. I think it's a lot easier for somebody sitting on the call who's about to start a business and they're starting with a blank sheet and saying, okay, I'm going to build my facility to be like this. That's a lot easier for them versus somebody who's maybe had a business for 25 years and they're going to have to invest in transition or change. And so from where I sit and what I see, I don't think anybody is expecting us to snap our fingers and do this in one day. I think smart investors want to know that the companies they're investing with have a plan and that plan is sustainable, and not just sustainable from the, you know, carbon output perspective, but that the business operations are sustainable, because it's not helpful if you've transitioned your business to be fully carbon neutral, but you're now losing money. The investors don't want that. So, you know, it really is a partnership approach, and you need to think about what your business can sustain. And, you know, I think there's also investors who are willing to help invest some of that transition. So it is expensive to go from, you know, diesel to electric, and those are things that certainly, you know, Bonafield is looking at to support folks with, but there are others, I'm sure, in this space, you know, so things like biodigesters and in that type of thing. Investors are talking about those things. So hopefully, you know, people aren't leaving the call thinking, oh my gosh, what do I have to do? This is too burdensome. I don't think that's the case. I think there's real opportunities, and there's aligned investment dollars looking to support that. But you need to, again, make sure that it's the right fit for your business, because you don't want to give up your future success either just to do this.
Thank you, Andrea. Phenomenal way to end it. Yes, it's a challenge. There's a lot to think about and adopt here in regards to ESG. And it doesn't seem it seems like it's only going to continue to emerge as a factor in investment. But that might be an opportunity for our members, and now they're equipped with some tools to get them further down the road and make a decision. So thank you everyone for your participation. To all the panelists, very much appreciated. I know, you know, some of you are taking time out of your vacation and otherwise out of your busy work days. So big thank you. I'd like to quickly thank also the comms team for their support in getting the message out there and managing today's tech for the event, and I guess thank David McGinnis for his support in putting this panel together. He was instrumental, and he was missed today. And then so with that, happy to let everyone get on with their day right at 11:14 here. So thank you once again. Very much enjoyed this panel, and I'll probably go back and watch it again myself and try not to look at myself. So thanks everyone. Have a great day. Much appreciated.
Thanks, Brent.
Thank you.